Says this is setting up to be one of the hottest stretches for the market. Joining me now, Carson Group Chief Market Strategist Ryan Detrick. Good to see you again. Why do you think so?
Yeah, thanks for having me, and happy Memorial Day to everybody out there. And 13 years ago, we lost Mark Haynes, so let's remember him, right? But listen, I came on with you a few weeks ago, Scott, and we said, don't sell in May, go away, right? Usually May does pretty good, especially in an election year, and sure enough, that's happening. So we've been on record. We think we could have a surprise, we'll call it, surprise summer rally. And you look at June and August, usually not that great of months. On average, those months are up 1.3% for the S&P 500, Scott, much better than expected. So we can get into some of the other weeds of this, but the bottom line is we had that washout that we saw back in April, and we think, again, kind of like Professor Siegel, I'm not one to go against Professor Siegel, we think the upward bias is still alive and well.
Let me ask you a question. You know, this week we got scared for a minute. The minutes of the Fed were hawkish, right? Even though they were backward looking, it still had an impact on the market. What happens if at the Fed meeting, if you're looking for a summer rally, what happens if at the Fed meeting, which is not backward looking, okay, right, in a couple of weeks, what if Chair Powell is more hawkish than maybe we really expect him to be? Does that upset what you say?
I think it would, Scott. I mean, I think it would. I mean, we think we're seeing some better news on inflation with CPI. We all talked about this a lot. It's all about shelter. We've seen rent prices starting to go lower, so that should lead to OER. Those are some positive signs. If they come out hawkish, yeah, that could upset it. But let's be honest. We hear all these different Fed speakers. We still know what Chairman Powell's been saying. He wants to see the data. I know we've got PCE coming out soon, so we'll cross that bridge when we get there. But I do think we don't expect that, I guess is what I'm going to say here.
Okay. What gets us, or what powers us towards this summer rally that you suggest is likely?
Yeah, well, it's probably some of that conversation we just had. Some better inflation data, obviously. We just look at the last 2 days. I mean, some of the economic data that we've seen, this economy is not slowing down. That Atlanta Fed GDP now over 3%. I mean, these are strong. But here's what to think about. Yesterday was the 100th trading day of the year. After 100 days, this is the best start to an election year ever. Now, what in the world does that mean? Scott, I found 20 times the first 100 days were up at least 10%, double digits. The rest of the year has been higher 85% of the time, with a median rest of the year return of another 10%. What I'm getting at, strength usually begets strength. With some better inflation data, with the economy still strong, those are all reasons we've been overweight equities for a long time, and we're still in that camp.
Okay, so if strength begets strength, does that mean that internally I want to continue to lean into the mega cap tech stocks?
We don't think so. I mean, we're more neutral mega cap here when you look at mega cap tech. When you look at it, I mean,
why?
I look at well because we look at valuations, right? We look at valuations and look at a 20-year valuation, 2 standard deviations above their long-term trend. So again, that's pretty pricey. And again, under the surface, I mean, just for year to date, 10 out of 11 sectors are higher. Real estate, yeah, it's lagging, but we are seeing more broadening out this year. And to us, we've been adding on any weakness, industrials and financials. I know the discussion before I come on, great panel discussion there. They kind of talked about that, and I agree. I mean, those cyclical areas to us still look good, especially if you get a rate cut or two. We think that can help kind of juice the economy just that little bit more, and we like those cyclical areas, specifically industrials, financials, the rest of this year.
Shouldn't you be paying a premium? And I mean, look, it's not like all of these stocks are trading at some crazy premium. You got balance sheet, you got cash flow, you got buybacks, you got dividends, you got AI, you got safety alleged. But you know what I'm getting at, right?
Yeah.
You should be paying a premium of some sorts for all the things that I just ticked off, right?
Oh, you're right. You got earnings, too. I think last I checked, that's where a lot of the earnings are coming from. So, again, we're more neutral. I'm not saying we're bearish, that group. We have large cap exposure. I mean, but again, when we look into it the next 6 months or so, and I know everyone's just before I came on, you talked about these small and mid caps. Mid caps have been our largest overweight bet, right? The Jane Brady group, if you will, slowly doing really, or quietly doing really well this year. And again, small caps, we've got a slight overweight there. And again, the whole theme I just came on with earlier, if you start to get a little better inflation data, we think small caps can do well. One final thing on small caps. They gained 24% the last 2 months last year. That's one of the greatest 2-month rallies ever, Scott. I looked at the last 10 times they had that. A year later, higher, like 20% a year later. So I know they're sideways the first 5 months this year. We're not giving up on them yet.